Today we're going to talk about Stanley Miller's investing rules and how you can use them to make better financial decisions. Stanley Druckenmiller is a legendary investor who has made billions of dollars following some simple investing principles. In fact, he's one of the most successful investors of all time. So if you want to invest with Stanley Druckenmiller's principles in mind, here are some of the insights that you need to know to begin. Remember that these are just examples to learn about why. The why, that's what we need to understand, of why you would want to invest based on current market trends rather than as a blueprint to copy. Today we see so many people that are simply copying what another is doing. Perhaps it's an influencer on YouTube and they don't understand why, but that's what we'll discuss here and now. Invest in companies with strong balance sheets and high returns on invested capital. One of Stanley Druckenmiller's key principles is to invest in companies with strong balance sheets and high returns on invested capital. This means that the company should be able to generate a lot of profit with minimal investment. Some examples of companies that meet this criteria include Amazon, Microsoft, Alphabet, Apple, Visa, and Johnson & Johnson. These companies have a strong track record of generating high returns for their shareholders, and they also have solid financials. Like I said, just examples. Do not simply take that and run with it, okay? I'm just trying to highlight this. Buy stocks of companies with a durable competitive advantage. Another key principle is to buy stocks of companies with a durable competitive advantage, and this means that the company should have a sustainable advantage over its competitors. Some examples of companies that meet this are Coca-Cola, Nestle, PepsiCo, Walmart, ExxonMobil, and Procter Gamble. And one example here with Coca-Cola, it's interesting because if you remember, Richard Branson launched his own Virgin Coca-Cola, and it didn't do well. He thought if I could just capture 1% of the Coca-Cola market, it would be enough to have a successful business. He was not able to do that, even though when they did blind testing, people tasted both and they said they were great. They loved both the Coca-Cola and the Virgin Cola, but people chose the Coca-Cola because of the brand, because of the awareness, and they were simply used to the taste of Coke. It wasn't that the Virgin one wasn't as good. It was that they were used to the taste of Coke, so they would always choose the Coca-Cola. Okay, so that's just something that's been around for a while. That same principle applies to so many other businesses and sectors as well. These companies have a strong brand image, a wide customer base, and a solid distribution network. You can go to any country in the world and get Coca-Cola. It's something that you can't say about many other companies, right? So that's when you know that they have the distribution to get into all these countries, literally into the back and beyond of the world. This company is there. Invest in businesses that are easy to understand and have a clear path to future growth. Stanley Druckenmiller also recommends investing in businesses that are easy to understand and have a clear path to future growth, which means that you should invest in companies that you understand, okay? Some examples of the companies are Starbucks, McDonald's, Bank of America, JP Morgan, and Home Depot. You know what's happening with Starbucks. People line up outside the door. People are willing to spend $4, $5, $6 to get a coffee because they have this brand awareness. People are gathering towards it. They can go there and they can get what they want. They have an expectation of what that will be, and they can get it at these places. That is really saying something about the business. These companies have a clear business model, a strong brand, and a solid track record of growth as well. Something that for a lot of companies, it's really just a fantasy. Oh, we have this idea, or we believe we're going to make money in the coming years. Stanley Druckenmiller believes that you shouldn't invest based on today. You should be investing based on how this company will operate in the near future and the distant future. So it's very important. It has to have those strong fundamentals today, but also in years' time. Buy stocks with low price to earnings ratio. Price to earnings ratio, something I talked about in my first book, But another principle is to buy stocks with relatively low PE ratios. This means that you should look for companies that are undervalued in the market. Some examples of the companies might include, depending on when you're watching this, Microsoft, Amazon, Berkshire Hathaway, Visa, Walmart. Like I said, once again, just some examples. These companies have a low PE ratio, which means that they are undervalued by the market by one metric and have the potential for significant growth. Investing in stocks with a long-term outlook. He recommends investing in stocks with a long-term outlook, which means that you should look for companies that have a solid track record of growth and that are likely to continue that growth into the future. That's what I was explaining a minute ago. They got to be doing well today. It's not as if, okay, we're losing a lot of money right now, but in 10 years, we're going to be doing real good. That's not the type of companies he likes. You might invest in those type of companies, but that's not exactly what he suggests. Some of the examples include, and I want to say this for a reason, Vanguard Total Stock Market Index Fund, Vanguard S&P 500 Index Fund, Schwab S&P 500 Index Fund, and Fidelity 500 Index Fund. Why? Why would I suggest this? Well, when you look at index funds, you are not worrying about individual companies. You are simply understanding that you believe the market will grow 5 years, 10 years, 20 years down the line. And you could simply say that I don't really know if Amazon's still going to be a stronghold in 10 years or 20 years, and I'm not going to be managing my portfolio. So the best thing to do instead of owning a mutual fund is to simply own the stock market. There are issues with this and ETFs, and I've brought that up in previous videos. But for most people, trying to stock pick is generally going to end up very bad. You can invest in one company, it does so well, it's going amazing. You start putting more and more and more, but hey, wait a minute, that was the top, and it starts to come down. You do have some profit because of those initial investments, but you also bought up here, and that kind of evens things out, and it's not so good. On average, people will do better simply by having the total index inside their portfolio versus trying to actually pick stocks. And that's just the way it goes for a lot of people. These funds invest in a diversified portfolio of stocks, have a long-term outlook, which makes them a great option for investors who want to minimize the risk and maximize their return over the long period of time, because like Druckenmiller, Buffett says the same thing, whereby rule number one, never lose money. I think that's so key, and a lot of people don't realize that, especially when they're just starting out, when they're not aware of all the information. That's why a lot of these influencers that you see on YouTube, they generally are trying to tell you too much information because they're just not aware, okay? They're just really ignorant to it all, and they have an audience that they need to preach to, so it's understandable. If you want to invest with the principles of Stanley Druckenmiller, you should focus on investing in companies with strong financials, a competitive advantage, a clear path to growth, not just the path to growth, and a low price to earnings ratio. You should also consider investing in stocks with a long-term outlook, perhaps that includes index funds, to minimize the risk and maximize your returns over the long term because you expect to lose less money. These investing principles can help you gather the why you should want to buy something rather than blindly putting your hard-earned dollars into something that you may not understand. That's really what this is all about. You got to know why. That's what this video was. It's not to tell you to buy Amazon and Apple and all this. It's simply that we got to know why. Okay, we want to have those fundamentals in place. We want to realize that this company is doing good today and the expectation is that they're going to do good tomorrow as well. Things will change. Whether you're in your position right now in your employer, wherever you're employed, that might be totally different in 10 years from now. So it's hard to determine this, but at least there's a track record that goes behind, and we could see kind of where the path is laid out in front. A lot of these businesses, we could see that they're trying to expand globally. That might be a good thing as long as there's jobs moving into those places where they're moving in, and there's general employment and general economic growth. Okay, this is a good thing for the company. It's positive. If they're going into a place that's sinking down to the ground, probably not a good idea. Okay, you might be the first store or whatever on Antarctica, but not that many customers coming through. Okay, so that's kind of what I'm saying here for today. I hope you appreciate this information. Very generic financial information, but this gives you a look. Perhaps you have a portfolio, perhaps you have a 401k or RSP or a super, and you could say, you know what, I'm going to reevaluate that. So this is what this video was about. If you have any suggestions, if you have any information, please let me know in the comments below, and I'll see you tomorrow. Take care.